Margin call. Banks losing $4 billion as silver reaches $80 between Friday's market close and Monday's opening bell. Something happened in the silver market that Wall Street will never openly discuss. 64 hours. That's all it took. $4 billion evaporated from institutional balance sheets. Not over months, not over weeks. In a single weekend gap. The commercial banks who spent years shorting silver to suppress its price just received the margin call of the decade. But here's what they're not telling anyone. This isn't just about silver. This is about what happens when paper markets collide with physical reality. And the mathematics of what comes next changes everything. Welcome to Financial Crisis Explained. If you've built something in your life, if you understand that markets don't forgive ignorance, then this channel was created for you. We don't chase headlines here. We analyze the structural breaks that rewrite the rules. If that matters to you, press that subscribe button and tell us in the comments, where in the world are you watching this from? Because what's unfolding in the silver market right now doesn't respect borders. Let's begin. The silver market doesn't sleep. It trades 24 hours across 3 continents, moving through electronic exchanges in Tokyo, London, and New York with mechanical precision. But between 4 p.m. Eastern Time on Friday and 9:30 a.m. Monday morning, something broke that precision. When the New York Commodity Exchange opened on Monday, silver wasn't where it was supposed to be. Friday's closing price, $76 per ounce. Monday's opening price, $80.70, a $4.70 gap in 64 hours. For context, silver rarely moves more than $2 in an entire week. This wasn't volatility. This was a structural fracture. And somewhere in lower Manhattan, in the risk management departments of the world's largest bullion banks, screens were flashing red. Because when you're short silver, when you've sold contracts for metal you don't actually own, a $4 overnight move doesn't just hurt, it triggers margin calls, immediate margin calls. Let's establish the mathematics with clinical precision. The Commitments of Traders report, published weekly by the Commodity Futures Trading Commission, reveals commercial trader positions in futures markets. As of the most recent data before this move, commercial traders held a net short position in silver estimated between 800 million and 1 billion ounces. These aren't speculators, these are institutions, banks, market makers, entities with balance sheets measured in hundreds of billions, and they were caught on the wrong side of history. 800 million ounces multiplied by a $4 price increase equals $3.2 billion in mark-to-market losses. If the true short position is closer to 1 billion ounces, and multiple independent analysts believe it is, then the loss crosses $4 billion. Not projected losses, not theoretical exposure. Actual losses that must be settled in cash immediately. This is how futures markets operate. There is no grace period, no negotiation. The exchange calculates your loss at the end of each trading session and demands cash to cover the difference. It's called variation margin. And when the market gaps open, when price jumps without trading in between, the variation margin demand arrives all at once, $4 billion, in less than 3 days. Now, for institutions accustomed to managing billions, this might seem absorbable, but absorption requires liquid capital, cash, treasury securities that can be sold immediately, credit lines that can be drawn without triggering counterparty concerns. And here's where the mathematics becomes dangerous. These banks don't hold $4 billion in idle cash, waiting for silver to spike. They're leveraged. Their capital is deployed across hundreds of positions. Stocks, bonds, currencies, commodities, derivatives. To raise $4 billion in 72 hours, they must liquidate something else. Sell performing assets, draw expensive credit, or, and this is what keeps regulators awake at night, fail to meet the margin call. History provides uncomfortable precedent. In March 2022, the London Metal Exchange suspended nickel trading because a single Chinese firm couldn't meet margin calls after nickel doubled in hours. The exchange, faced with the choice between allowing a member default or halting the market, chose to halt the market. They canceled trades, rewrote the rules mid-crisis. In September 2021, copper spiked so violently that several hedge funds faced liquidation. In 2008, oil's collapse from $147 to $33 destroyed commodity trading desks at major banks. Silver at $80, with a $4 billion margin call hitting simultaneously across multiple institutions, sits in that same category of systemic stress. But there's a deeper question here. A question that separates casual observers from strategic thinkers. Why did silver gap in the first place? Markets don't jump $4 overnight without reason. Something changed. Either physical demand surged beyond available supply, or confidence in paper silver contracts. The futures and options that create synthetic supply began to crack. Both possibilities lead to the same conclusion. The mechanism that kept silver suppressed for years the endless rolling of short positions, the creation of paper supply to overwhelm physical demand, just encountered a force it cannot control. And when suppression mechanisms fail in commodity markets, the moves don't unfold in percentages, they unfold in multiples. The commercial banks who built these short positions did so under the assumption that they could always roll forward, always add more contracts, always outlast the buyers. That assumption, as of Monday morning at 9:30 a.m. Eastern, is now a $4 billion mistake, and the clock is ticking. Because margin calls don't wait for strategy meetings. They demand cash. Now, there are names you know, and then there are names that run the machinery. When most people think of banking, they think of mortgages and checking accounts, but there exists a different category of institution. Bullion banks. They don't advertise on television, they don't have retail branches, their clients aren't individuals, they're central banks, mining companies, sovereign wealth funds, and other financial institutions. And their primary business is controlling the global flow of precious metals. JP Morgan Chase, HSBC, Bank of Nova Scotia, Goldman Sachs. These aren't speculative hedge funds taking directional bets. These are market makers, institutions designated by exchanges to provide liquidity, to ensure there's always a buyer and always a seller. But here's where theory diverges from reality. Market making requires holding inventory, both long and short positions, buying when others sell, selling when others buy. In a perfectly balanced world, these positions offset. No directional risk, just the spread between bid and ask, but the commitments of traders' data, published every Friday by the Commodity Futures Trading Commission, tells a different story. For years, commercial traders in silver have held massively net short positions, not balanced, not neutral, short, consistently short, aggressively short. As of recent reports, the commercial category, which includes these bullion banks, holds short positions exceeding long positions by 800 million to 1 billion ounces. This isn't market making. This is directional betting. And this is where it gets structurally dangerous, this is price suppression masquerading as liquidity provision. Let's examine the mechanics. Silver has industrial applications. Solar panels rely on silver paste for conductivity. Electronics require silver contacts. Medical devices use silver for antimicrobial properties. And unlike gold, which sits in vaults after purchase, silver gets consumed, destroyed in manufacturing processes. The Silver Institute estimates annual industrial demand exceeds 900 million ounces. Total mine production? Approximately 800 million ounces. There's a structural deficit. And yet, for 3 consecutive years, silver's price remained range-bound between $22 and $30. Physical deficit, suppressed price. How? Derivative supply. On the COMEX Futures Exchange, traders don't exchange physical silver. They exchange contracts, promises to deliver silver at a future date. But here's the critical detail. Less than 2% of COMEX contracts ever result in physical delivery. 98% are cash settled, meaning the exchange doesn't require actual metal, just money changing hands based on price movement. This creates synthetic supply, paper silver, contracts representing metal that doesn't exist, flooding the market alongside contracts backed by actual inventory. Analysts estimate the ratio of paper silver to physical silver ranges from 100 to 1 up to 250 to 1. For every ounce of actual metal, there are 100 to 250 ounces worth of contracts. Now, this system functions perfectly, as long as nobody asks for delivery, as long as buyers accept cash settlement, as long as confidence in paper markets holds. But confidence is not a constant. Between 2008 and 2013, the CFTC conducted a formal investigation into silver market manipulation. The investigation centered on whether bullion banks were coordinating short sales to suppress prices. After 5 years, the CFTC closed the investigation without charges, but they didn't say manipulation wasn't happening. They said they couldn't prove intent under existing legal standards. That's not exoneration. That's a technicality. And the market behavior continued. Every time physical demand surged, commercial short interest increased. Every time silver approached technical breakout levels, large short positions appeared in overnight trading. The pattern became so consistent that independent researchers began documenting it. Mining companies noticed it. Industrial buyers noticed it, and slowly, a question began forming in professional circles. What happens if the shorts can't cover? In a normal market, short sellers buy back their positions to exit. But if 800 million ounces are sold short, and annual mine production is 800 million, and industrial demand already exceeds supply, where does the metal come from? The answer, as of this Monday morning, is that it doesn't. The short sellers aren't covering with physical metal, they're covering with cash, paying the difference between their short price and the current market price, and that difference just widened by $4 in 64 hours. This is the architecture of accumulated risk, years of suppression, built on the assumption that paper markets control price discovery. built on the assumption that physical demand can always be satisfied with cash settlement, built on the assumption that leverage works indefinitely, until suddenly it doesn't. And when leverage unwinds in commodity markets, it doesn't ask permission. It doesn't wait for board approval. It sends a margin call, $4 billion, due immediately. The institutions holding these positions didn't build them recklessly. They built them systematically, with regulatory approval, with mathematical models, with risk management frameworks. But risk management assumes normal distributions. It assumes historical volatility predicts future volatility. It assumes that a market trading in a range for 3 years will continue trading in that range until it doesn't. And 64 hours ago, normal broke. The question now isn't whether these institutions can absorb a $4 billion loss. The question is what happens when they try. Because liquidating $4 billion in positions in a market already moving against you creates something far more dangerous than a loss. It creates a cascade. When COVID lockdowns hit, the Federal Reserve opened 14 different emergency lending programs in 2 weeks. Not because banks were insolvent, but because they couldn't sell assets fast enough to meet margin calls and redemptions. Liquidity crisis, not solvency crisis, but liquidity kills just as effectively. The silver margin call, as of Monday morning, sits at that exact inflection point, $4 billion in losses, requiring immediate cash, in a market where raising $4 billion quickly means moving other markets, and moving other markets means creating new risks. The clearinghouses that process these transactions, CME Group for COMEX Silver, are watching this in real time. Their job is to ensure that every trade settles, that margin is posted, that the system doesn't break, but their tools are limited. They can increase margin requirements, forcing more cash into the system. They can issue intraday margin calls, demanding payment multiple times per day instead of once. They can, in extreme circumstances, halt trading, rewrite rules, cancel transactions. They did it in nickel. They can do it in silver. And if they do, confidence in commodity, futures markets, across all metals, all energy products, all agricultural contracts, cracks. Because if the exchange can cancel your winning trade, why participate at all? This is the cascade. Loss becomes liquidation. Liquidation becomes contagion. Contagion becomes intervention. And intervention becomes the end of normal market function. $4 billion, 64 hours. The question isn't whether institutions can survive this. The question is whether the market structure can. The liquidation itself is creating losses in other positions. A second-order effect. The margin call forces sales, which creates losses, which may trigger additional margin calls in other positions. This is cascade mechanics. Option 2, draw credit lines. Most major banks have standing credit facilities with other institutions. Billions in borrowing capacity for exactly this type of emergency. But, and this is critical, drawing massive credit at 3 a.m. sends a signal to counterparties, a signal to the market. We have a liquidity problem. And in modern financial markets, perception is reality. If other institutions believe you're in distress, they widen credit spreads, they reduce exposure, they start unwinding their positions with you, just in case. This is counterparty risk propagation. One institution's margin call becomes 5 institutions' risk reduction. Now multiply this across the entire commercial short position. It's not one bank, it's not one $800 million margin call. It's multiple institutions, all facing the same problem. At the same time, JP Morgan needs to raise cash. HSBC needs to raise cash. Scotia needs to raise cash. Goldman needs to raise cash. Simultaneously. They're all selling similar assets to raise it. Treasury bonds flood the market. Prices fall. Yields spike. Now the bond market is moving, and the Federal Reserve, which monitors Treasury market functioning obsessively, sees unusual volume, unusual price action. They start asking questions. Is this a liquidity event? Do we need to intervene? This is how a $4 billion loss in silver becomes a systemic concern. Because modern financial markets aren't siloed, they're interconnected. Margin calls in one market create liquidations in another, which trigger risk reduction in a third, which forces central bank monitoring in a fourth. The 2008 financial crisis didn't start as a systemic event. It started as subprime mortgage losses at a few institutions. But those losses triggered margin calls, which forced asset sales, which revealed that other institutions held the same assets, which created a crisis of confidence, which froze interbank lending, which required government intervention. The pattern is always the same. Leverage works beautifully until it doesn't. And when it unwinds faster than institutions can react. There's a term in risk management, liquidity spiral. It describes what happens when the need to raise cash forces sales that decrease asset values, which increases the need to raise more cash, which forces more sales. A self-reinforcing loop? And the only way to stop it is external intervention, central bank liquidity, regulatory suspension of trading, emergency credit facilities. In March 2020, there's a phone call that nobody wants to receive. It comes from the risk management desk, not during market hours, but at 3 a.m., when Asian markets are open and New York is sleeping. The voice on the other end is calm, professionally calm, but the message is not. We have a margin deficiency, variation margin due by London Open, amount required, $1.2 billion. This isn't a request. This isn't a proposal for next week's risk committee meeting. This is operational reality in the futures market, and it's happening right now across multiple trading desks, at multiple institutions, simultaneously. Let's deconstruct what variation margin actually means. When a trader enters a futures position, they post initial margin, collateral. Think of it as a good faith deposit, typically 10 to 15% of the contract value. For a silver contract, that might be $8,000 per contract. But initial margin isn't the dangerous part. Variation margin is. Every single day, at the end of the trading session, the exchange calculates profit and loss on every open position. If you're profitable, cash is deposited into your account. If you're losing, cash is withdrawn immediately. This is called mark-to-market settlement, and it happens whether you're ready or not, whether you have the cash or not, whether your CFO approved it or not. Now, in normal market conditions, variation margin moves are manageable. Silver goes up 30 cents, you post some cash. Silver goes down 40 cents, you receive some back. The daily swings are predictable, budgeted, within risk parameters. But when silver gaps $4 overnight, when there's no trading between 76 and 80, the variation margin demand doesn't arrive in increments. It arrives as a lump sum, $4 per ounce, multiplied by the total short position. For a bank short 200 million ounces, that's $800 million. Due immediately, not next week, not after executive approval, by the next settlement window. And here's where it gets systemically dangerous. These institutions don't hold billions in cash sitting idle. That would be inefficient. Capital is deployed, invested in treasury bonds, corporate debt, equity positions, real estate, lending facilities. Every dollar is working. So when $800 million in variation margin comes due, something else must be liquidated fast. And liquidating at speed means liquidating at a discount. Let's walk through the mechanics. The margin call arrives at 3 a.m. New York time. London opens in 4 hours. The trading desk has two options. Option 1, sell liquid assets, treasury bonds, high-grade corporate bonds, blue-chip equities. These can be sold quickly, but selling $800 million in 4 hours moves the market. Bond prices drop, stock prices drop, and now they don't announce it in press releases. They quietly rotate into hard assets, real estate, commodities, precious metals. The silver move, especially at this magnitude, suggests that rotation is accelerating. And if that's correct, then the implications for business decision makers are profound. Currency risk is no longer theoretical. For decades, corporations operating internationally managed currency exposure through forwards and options, predictable tools, liquid markets. But if underlying currency stability comes into question, if inflation proves structural rather than transitory, if central banks lose credibility in maintaining purchasing power, then currency hedging doesn't eliminate risk. It just transfers it to a counterparty who may not be able to perform. This brings us to counterparty risk, the shadow lesson of every financial crisis. In 2008, firms holding AA-rated mortgage securities discovered that ratings meant nothing when the underlying assets collapsed. In 2020, firms holding oil futures discovered that prices could go negative when storage capacity disappeared. In 2022, firms holding Russian assets discovered that geopolitical risk could erase value overnight regardless of fundamentals. And now, in 2025, firms holding paper claims on physical commodities are discovering that paper and physical are not equivalent. The strategic principle is simple. If you cannot take physical delivery, you do not own the asset, you own a contract. And contracts are only as good as the counterparty's ability to perform. When margin calls reach $4 billion, counterparty performance becomes a legitimate question. So what does this mean operationally? For manufacturing businesses, relying on commodity futures for input cost hedging is no longer sufficient. Physical inventory becomes strategic. Stockpiling becomes rational. Long-term supply agreements with producers become more valuable than financial hedges. For treasury departments, holding only financial assets creates concentration risk, not concentration in a single stock or bond, but concentration in financial system functionality. Diversification now means holding assets that exist outside the banking system, physical commodities, real assets. Bitcoin and other decentralized monetary alternatives, not as speculation, but as insurance against systemic financial dysfunction. For business leaders making capital allocation decisions, The cost of capital just became more complex. Interest rates tell you the nominal cost of borrowing. But if currency debasement accelerates, if commodity input costs spike unpredictably, if counterparty risk in financial markets rises, then the real cost of capital includes factors that don't appear in bank quotes. The framework for evaluating this starts with a simple question. What happens to your business if financial markets stop functioning normally for 6 months? Not collapse, not crisis, just stop functioning normally. Delayed settlements, wider bid-ask spreads, reduced credit availability, increased collateral requirements, commodity price volatility that exceeds hedging capacity. How resilient is your operating model? The firms that survive the next decade won't be the ones with the most leverage, they'll be the ones with the most optionality. Physical inventory instead of just-in-time delivery. Direct supplier relationships instead of spot market dependence. Balance sheet liquidity instead of maximum financial engineering. Operational flexibility instead of optimization for a single scenario. The silver market, with its $4 billion margin call, is teaching a lesson that applies across every sector. Leverage amplifies returns in stable environments, but stability is not guaranteed. And when instability arrives, it doesn't send a warning letter. It gaps the market overnight. The institutions facing margin calls today had risk models, had stress tests, had regulatory oversight, had decades of market experience, and none of it mattered, because their models assume that the past predicts the future, that correlations hold, that liquidity is constant, that paper and physical remain interchangeable. Those assumptions, as of this week, are now provably false. For business leaders, the strategic response is not to abandon financial markets. It's to recognize their limitations, to build resilience that doesn't depend on their perfect functioning, to hold assets that have value independent of counterparty performance, to maintain optionality when others are over-optimized. The firms that understand this won't just survive the next crisis, they'll acquire the assets of those who don't, at discounts that only appear during dislocations. Because while markets are fracturing, opportunities are being created. The question is whether you're positioned to see them. $4 billion lost in 64 hours. That's the cost of assumptions. The value of preparation is still being calculated. Strip away the drama, remove the headlines. What remains is a signal. And signals matter because they reveal structural truth before consensus catches up. The $4 billion margin call in silver is not an isolated event in an obscure commodity market. It is a fracture line, a visible crack in the architecture of modern financial markets. And for anyone allocating capital, building a business, managing treasury operations, or making multi-year strategic decisions, this fracture demands analysis, not panic, analysis, because the implications extend far beyond silver. Let's start with the most immediate question. If silver can gap $4 overnight, if institutional short positions can accumulate to a point where a single weekend creates billion-dollar margin calls, what other markets are sitting on similar structural vulnerabilities? The answer is uncomfortable. Copper. The London Metal Exchange shows commercial net short positions in copper that mirror silver's concentration. Copper is not a speculative asset. It's the backbone of electrical infrastructure. Electric vehicles require 80 pounds of copper per vehicle. Data centers require tons of copper for wiring and cooling systems. Renewable energy infrastructure is copper intensive, and global mine production is not keeping pace with projected demand. If copper experiences a similar gap move, the margin calls won't be $4 billion. There'll be multiples of that. And the impact won't be confined to trading desks. It will hit procurement departments, manufacturing cost structures, infrastructure project budgets, platinum and palladium. Both metals trade with similar derivative structures. Both have industrial applications that cannot be substituted easily. Catalytic converters, hydrogen fuel cells, chemical processing. If the paper-to-physical ratio breaks in these markets, automotive and energy sectors face input cost shocks that no hedging strategy anticipated. But the vulnerability extends beyond metals. Agricultural futures, wheat, corn, soybeans, all trade with massive speculative positions layered on top of commercial hedging. The drought in Eastern Europe last year, combined with export restrictions, created a situation where physical wheat was unavailable at any price in certain regions, while futures markets continued trading normally, until they didn't. When physical delivery demands exceed available supply, futures markets either settle in cash or they break. Energy markets. Natural gas in Europe during the 2022 energy crisis saw price moves that bankrupted trading firms and forced government intervention. Not because the firms were reckless, but because the gap between paper positions and physical delivery capacity exceeded what risk models considered possible. The pattern repeats. Derivative markets function until physical reality intrudes, and when it does, the adjustment is not gradual, it's violent. Now, let's connect this to monetary policy. Why is silver moving in the first place? Yes, there's industrial demand. Yes, there's supply deficit. But $4 overnight gaps don't happen purely on supply-demand fundamentals. They happen when confidence shifts. Confidence in what? In the purchasing power of currency. Silver, like gold, serves as a monetary alternative, not officially, not legally, but functionally, when institutional allocators, sovereign wealth funds, family offices, pension funds, when these entities start questioning whether holding dollars or euros or yen preserves value,